Welcome to the Investing with IBD podcast sponsored by Vantage Point. It's Justin Nielsen, your host, and along with me, as he is every week, is Arusha Paris, O'Neill Global Advisors Portfolio Manager. We've got a brand new year for you. It's January 5th, 2022. Hope you all had a happy new year. And to start out our new year, we're going to go ahead and introduce our guest today. It's Jeff Hirsch, who you might know from the Stock Traders Almanac, one of those things that most investors like to have handy as they check out the stats. So welcome back to the show, Jeff. It's so good to have you on today.
Great to be with you guys. Happy New Year, guys.
Happy New Year to you. So speaking of Happy New Year's, one of the things we're going to talk about is, of course, the January barometer, the trifecta, all of these different indicators that Jeff looks at. Not only are we going to talk about those indicators, but really kind of put it all together and how you use some of this information that's, this Stock Traders Almanac is just chock full of data. And then we're going to get a couple stocks from Jeff as well. So let's get right into it and start with the market. Today's action on Wednesday here, January 5th, was not great. A lot of the indexes were down. The NASDAQ probably the hardest hit. We're going to be going to uptrend under pressure. That's not something we usually announce, but since this is going to be dropping tomorrow, you guys get the sneak preview there. So Jeff, what is your take on the market as it stands?
Well, I mean, today's sell-off is concerning, but Santa Claus rally came in. This is Yale Hirsch invented that back in 1972. It was in the 73 Almanac. We had the positive return for the last 5 days of the year and the first of the new year. That's first positive when all three are positive with the first 5 days and the Santa Claus rally, the full month barometer. The results are great, but we'll get into that in a bit. But looking tactically here, yeah, we had a big sell-off today. I'm seeing some support, that hasn't been broken yet at those two lows there. My concern is that August high that you got there in the composite, the 15,403 number you're looking at. That's become sort of a support area for me, and we've been dancing through that, so that's some trouble. We are looking at a potential W123 bottom here. It's if it blows through that lower part, that's an issue for me. But we got some volatility from the Fed minutes today. There's a chart that season one we showed you guys for the typical January. It's ranked 5th for the Dow and the S&P now. Still number 1 for NASDAQ, but we've seen a lot of churning at the beginning of the year, and that's why we built that January indicator trifecta, which we created kind of about 7 or 8 years ago in the Almanac investor newsletter, with combining the 3 early year indicators: Santa Claus rally, first 5 days, and January barometer. And when all 3 are positive, it's a 90.3% times of the 20 out of 31 times, 90.3% that the year's up, about average 17.5% for the S&P. But when any one of those 3 indicators are down, it's concerning. So if the market can't reclaim this turf, this ground by Friday's close, which would be the first 5 days, I'm going to get more concerned. I'm going to temper my outlook a bit, which is already tempered because it's a midterm year.
And Jeff, last year, yeah, and last year we hit all 3, right? And we had a good year, and yeah, so once again,
no, January, I think,
or did we barely miss it?
We didn't get them.
Maybe
we missed it. We had 2 out of 3.
Oh, we had 2 out of 3 because we barely missed at the very last day, I think, or something. Was that it?
Same thing happened in 2022, COVID related both times.
Okay. So we did barely miss it, but that being, what's interesting with the barely. Well, I'm just looking at the January barometer part. Even like for the last few times the last 2 or 3 times, or the last 2 times, the market actually did finish positive. Still, it has been a pretty strong five years. So even those last couple of times that it had it, the barely essentially flat in 2020, and then in 2016 it was down 5.1%. The market finished up, but that before that, you had a little bit more. But it's more the positive, right, versus the negative, and all 3.
Yeah. So as I said, really crucial for the market to finish the week positive. for the year, be year-to-date positive for the trifecta to be in play. Otherwise, I'm going to get concerned. If January barometer comes in, positive for the full month, and we recover, and the Fed minutes, that they're actually selling assets and not just reducing their buying, and that they're not hiking so fast, becomes just a reaction and a fear on this one day, then great. But this year's on notice already. I mean, if you looked at my my forecast, I laid out a bunch of different concerns that we have, namely the midterm year itself, battleground for the parties. Usually as there's a page in the Almanac back toward, like in the hundreds there, about the losing seats. Everyone's been talking about that recently. It's a thing that the incumbent party, the incumbent president's party, the margins there, and the low approval ratings, and the Afghanistan, withdrawal debacle, and the failure to get the Build Back Better thing through, amongst other things, causing the president's approval rating to be down. It's really, fueling the opposition. And when you have the parties battle like that in a midterm year, you tend to see that weak spot of the Q2, Q3 of the midterm year really have an issue. And if you want to pull up that chart that you have in mind of the midterm election year seasonal pattern, you can see that on there.
You can see this, right?
You can see the, yeah.
Okay.
Yeah, there it is. You can see that week period, and the black line is all years, which is still flat, not as vertical or 45 degrees as most of the other times of the year. This is the best 6 months, worst 6 months. May to October being the worst 6 months. Another Yale Hirsch creation invention from the Almanac. But this weak spot, is where we get that tendency for midterm bottoms. Often down there in October, where you see that dip at the end of October. This is why we call the midterm year the bottom picker's paradise, because you had this weak spot here, the middle of the year, the 2 quarters. Then you get the sweet spot of the 4-year cycle, which is Q4 the midterm year through Q2 of the pre-election year, and even through the whole pre-election year, which is the 3rd year of the cycle, still the best year of the 4-year cycle, where the incumbents priming the pump to make the country and the citizens happy when they go to the voting booths. Mm-hmm. And you see an average of about a 48% gain on the Dow from the midterm low, whenever it occurs, to the pre-election year high, and a 70% average gain on NASDAQ from that midterm low to the pre-election year. So,
bottom picker's paradise indeed.
Yeah. NASDAQ's done some amazing things there, but this is a year we've been, and there's also reversion to the mean. I mean, we put out some posts on that a little while back, that these types of gains that we've seen, back on the anniversary of the COVID bottom, everyone was like, what was the Dow? S&P was up 75% or something from the low. And it's that's just unsustainable.
Right.
Right. A friend called me today asking about, should they sell some stocks for their mom's, healthcare, and I'm like, well, what's going to happen? There wasn't a whole lot of money, but, say the market's up 20% this year. You're going to have another, 8-10 grand? Is that going to make a difference? Or would you rather be, sleep well at night and have that cash, in the bank so that you can take care of mom?
Mm-hmm.
It's like, are we really going to get 20% again? Right. We could. It would be impressive. We've seen it at certain times. It might happen, but odds are it's probably going to be more in the high single, low double digits, the 7 to 12 type area. Actually, our forecast for this year, just so I don't mess it up, our base case scenario, 65% probability, S&P and Dow 5 to 10%, NASDAQ a little bit weaker. We're thinking, some of the growth stuff selling off. Best case scenario, about 25% probability, Dow and S&P 10 to 17%, NASDAQ weaker again. Worst case, trends deteriorate, Omicron new variants kick in, inflation doesn't moderate, Fed doesn't back off, and we're looking at a mild bear, down 10 to 20%. But that's only a 10% probability for us.
Okay.
Mm-hmm.
Okay.
Now, it's important, you kind of threw out a lot of statistics here and percentages and stuff like that. None of these are 100%, so people shouldn't come in and say, oh, well, Jeff said that the probability is high, or, this is likely, or what have you. So how do you use this information, when you know that there's, like with the trifecta, such a strong likelihood. When you get that 10% where it doesn't happen, how do you kind of protect yourself against those instances?
Well, I mean, you protect yourself in your portfolio with diversification and consistency in your strategies. We use our best and worst month switching strategy, but it's not just 1 year. Everyone likes to poo-poo sell in May and go away. What I like to say, buy in October, you get yourself sober, because they forget you got to buy the best 6 months, not just sell in May. But you got to be prepared to do it over years. Anything can happen in any given year. I mean, Putin could invade Ukraine, Israel could bomb Iran could send troops. I mean, whatever happens, we could have freezing ice, everywhere all the time, like we had today in New York area. So you prepare yourself with that 10% by not having all your eggs in one basket, old school stuff, and using several disciplines. We don't just use seasonalities. We use fundamentals, technical analysis. We're looking at monetary policy, and geopolitics and government policy. That's all one. And then psychology, sentiment, investors' intelligence, put call ratios, especially the weekly one of Barron's, and whether you want to use the AAII or market vein or whatever you're looking at, you want to see what the sentiment is. And I tend to be a bit of a contrary investor, contrary thinker. We don't chase momentum stocks. We like to look for stuff that's sort of off the radar, and we'll talk about the screens in a little bit, but you prepare yourself for that 10% by being smart about how you set things up ahead of time, and you have stops for some things. We never put a stop on our best and worst months switching strategy, because that's really strong seasonal. But all of our stock and ETF picks, we're using a stop. We use a look at some technical charts on that, but we don't do intraday stops. Not putting a hard stop in there. Okay. If one of the positions closes below that stop, we sell it the next day, because you don't want to get whipsawed in there. You don't want to put that stop out there for the market makers or the algos to fill you and knock you down and whipsaw you. So, you got to prepare for that always. But layering seasonality on top of your fundamentals, on top of technical analysis and what's going on in the world out there, it definitely improves your odds and your consistency and your discipline in general. So that's how you prepare for those events.
And I think it's key what you just said. It's not just 1 year. You might have 1 year that is that outlier, but then if you're doing this long term, that consistency can really become key.
That's it. Consistency.
Okay, when we come back, we're going to get into a little bit of the nitty gritty on how we use this information, all of this data that Jeff provides in the Stock Traders Almanac, in order to kind of come up with our plan. How do we put all of those layers that he just mentioned all together? So stay tuned. We'll be right back. Kicking yourself for that early exit? You can prevent them, and it's easier than you think. Go to freestockcoaching.com to see the tool independent traders are using to perfect their trades: artificial intelligence. AI doesn't involve staring at your screen for hours, and no research is needed. Just pick a stock and press a button. Visit freestockcoaching.com to see a live demo now. You need to be ready for rapid market changes, and AI can help you avoid potential losses. Check out freestockcoaching.com to learn more. Trading involves financial risk and is not suitable for all investors. Past results do not guarantee future performance. Okay, welcome back to Investing with IBD, sponsored by Vantage Point. It's Justin Nielsen here on the new year. And we also have, of course, O'Neill Portfolio Manager Arusha Pires joining us. And our guest today is Jeff Hirsch from the Stock Traders Almanac. Now, Jeff, you were sending out a lot of things that aren't necessarily in the almanac of 2022, because the January barometer, hey, that wasn't done yet. We still have to wait for the end of January. This first 5 days, you have to wait for that until Friday. So where can people kind of get some updates throughout the year on how things are shaping up?
Well, I mean, it's our digital newsletter. It's at stocktradersalmanac.com. And, you know, it goes back to Yale's day when he first started the Almanac actually started the year I was born, 1966. I am as old as the Almanac, 55 years old. And for the record, Pop just passed away at 98 on November 10th. And, you know, he's left us some big shoulders to stand on. And that's what we've done with the trifecta. But what happened after the Almanac was out for a few years, people were like, we want more throughout the year. So he started newsletters. I think the first newsletter we started in 73 was called Smart Money at the time. And we had another one, ground floor stock picking type newsletter. At one point, we were running several of them. Then I sort of consolidated them all into one. And now that we do a weekly alert instead of a monthly newsletter, but at stocktradersalmanac.com, you get the alerts. You also get a free copy of the Almanac, of course. And like just yesterday, we put out the, I'm just clicking over here, the Santa Claus Rally results, which comes on the second trading day of the year, the last 5 plus the first 2. And we'll put out another alert on Friday. These are the interim special alerts. We'll do one the end of January for the January barometer. And every Thursday after the close, we put out our series of alerts. We'll have our monthly outlook with our market at a glance, which covers those 5 disciplines I spoke about earlier, you know, seasonality, fundamental, technical, monetary, and psychology or sentiment. We do the January Almanac, which is the update of everything that's in the Almanac, what to look for this year, like the rankings, the ratings, the vital stats, what the bullish and bearish days are based upon our statistical analysis, the strategy calendar we have in the back of the book, and also on each given day of the year in the Almanac. If you want to flash that up there, Arush, or I want the little numbers there that show you the probability of how many times that day has been up on the S&P the last 21 years. And basically we update all that for each month with a little look at what's going on in the real world and currently. And then we have our stock update and our ETF update. And, you know, if it's a 5-week month, we'll do something a little more in depth, something we'll call the Proving Grounds, or a mid-month update with our market at a glance, the 5 disciplines, as well as on the Almanac, we have the strategy calendar, which is kind of like what's on each of the Almanac diary pages, but updated again for what's going on with current data about, you know, whether what's going on at triple witching day, triple witching week, the week after triple witching week, trading around holidays, you know, first and last days of the month. You can see some of that stuff. Oh, you're on my birthday week there.
Oh, look at that.
Did I put a good quote on my birthday on the 26th? Sometimes I
let me move over to the 26th.
Yeah. Are you trying to make sure people, you know, send you stuff?
No.
Which, by the way, I should mention that, you know, another way that people can follow up with you is on Twitter, and that's at Almanac Trader.
We have a lot of fun with that.
Well, certainly. And again, as you said, it's one of those things where, okay, the January isn't what it used to be. And so it's important to kind of get those updates. You know, so many people say, well, gosh, you know, is this time different? Well, maybe it is. You know, as you mentioned, there's so many exogenous. Yeah, right.
I mean, everything's a little different. And one of the things that's key with cycles and patterns in general is looking at things over multiple time frames. So, you know, we like nothing less than a 21-year time frame. I don't think that's statistically significant enough. And the reason why we don't use 20 is because you'll get an even number. You could have 10 up and 10 down.
Right.
21 will get some bias in there.
Get the tiebreaker in there at least.
Exactly. And then we'll look at, you know, going back to 71 when NASDAQ started, 49 or 50, you know, post World War II, anything prior to that, unless you're looking at the presidential cycles, not necessarily moot. I mean, things changed. You know, people look back further to either try to debunk the January barometer, which really came into effect with the 20th Amendment to the Constitution when they moved new Congresses convening to the January after they were elected versus 13 months later in the following December, because everyone used to be a farmer back in the day. And they also moved inauguration date to January 20th. So that's what created the January barometer. All those important political and decision-making events, along with the forecasting that everyone does for the year, happen in January. But they also will go back and try to, you know, debunk the best 6 months, or the best 8 for NASDAQ and a Russell. But if you go back before World War II, you're looking at an entirely different economy. It's an agrarian economy based upon farming. I mean, you had the rails were the big industries back then. And it was almost, I have a chart that I guess I could show you if I wanted to pull it up, but where you see going back 1901, where we have solid data, to 1949, it's almost buy in May versus sell in May, because that's the beginning of the agricultural season when you're buying fuel and seed and hiring people and sowing, and then it goes through harvest time. So now we have the military industrial complex and the service economy, which really drives that those best months as we're seeing here so far, unless we get some sort of event. If the Fed accelerates, if something goes wrong in Washington with Biden could mess things up more than some people think he is. We've got some geopolitical things out there, as I said before. Inflation, if that doesn't come down, we're expecting it to, but the Fed itself has admitted that they were a little sanguine, a little too sanguine on inflation situation.
A transitory part.
Yeah, it hasn't been, but inflation hasn't been around for a long time. You're about to have a little pendulum swing the other way. We'll just see if we can get through this 100-year generational pandemic situation we're dealing with, as well as the economic impacts with the supply chains and things. But and also that midterm year, I got to keep coming back to that. I mean, it's notoriously a rough patch for the market, as the politics are uncertain in the country.
Now, Jeff, I mean, your strategy and the way you're looking at the market is truly top down. I mean, it's going up a number of different layers. You're using all this history, the seasonality, and then drilling down, right, to use the technicals and fundamentals. How do you find some stocks? How do you screen for stocks and get some of those ideas when combining all of these other larger macro things?
We go both ways. We go bottom up and top down. So we have our seasonal overlay. So we're looking at getting into growth stocks around the beginning of the best 6 months. After we get our MACD seasonal buy signals. See there, we're layering a technical indicator, MACD, which I'm sure everyone here knows about, right, on top of the seasonality. So we've got the best 6 months of the year, November through April. We start looking for a MACD buy using the 817.9 on or about October 1st, first trading day of October. And we look for a new crossover, where the MACD line comes up through the signal line, or a histogram, whatever you want to call it. But also we look for confirm across Dow, S&P, and NASDAQ, so that we know the whole market complex is
so all confirm with the MACDs, all confirming there, or
yes, cool. All three MACDs give us the buy trigger. Okay. So we get that on the macro, the high end thing.
Yeah.
When we go into our screens. We do use Zach's research wizard for the fundamental thing. We have a whole host of criteria. We're looking at the acceleration of growth in revenue and earnings. We're looking for valuations, price to sales, price to earnings, book. We're looking for low margins and debt. And we're looking for consistency year over year and sequential quarter over quarter, as well as relative strength compared to the S&P, the market. We want something that's growing the business, accelerating growth, good valuation relative to the sector sometimes, depending on what it gives us, as well as not outpacing the S&P, but not lagging way below. And then we're going to look for things that are underfollowed, under Wall Street's radar, with only a handful of analysts versus a whole bunch. I jokingly, and I hope this isn't offensive, call it pre-canned slim. Sometimes. I mean, it's not called that, but it's like we're getting into some things that are have a little less momentum than what you guys do at IBD. And then we go to Market Smith, which we're subscribers to and love, and run, we'll take the 8,000 stocks, we sort them by hand in Excel, and then we will get down to about 50 or so, maybe, that look reasonable, that aren't like, fly-by-night things or anything. You got to have solid 10Qs and 10Ks. Yeah. And then we'll take that list and go into Market Smith and run through them. I love the charts there, cups and handles, all those breakouts that you were mentioning earlier. Yep. And also the canned screens on the right there, with whether it's O'Shaughnessy or O'Neill, or we look at them, just see what's going on there. And then we'll go into another charting software and look at the technicals to pick our buy limits and our stop losses. And, you know, we've got a few stocks that have done quite well. We found some winners there. I mean, my line is, you know, it's if you fail to remember the past, you're condemned to repeat it. But we think that those who study market history are bound to profit from it, and it produces a lot of, like, we found stocks that, you know, we had Scott's Miracle Grow before anyone knew what they were doing with, with the cannabis industry.
Fantastic, yeah.
ATEN, you know, and then, you know, we pair out. I mean, the key to investing in all these situations, everybody asks me one thing: sell your losers quick. Let your winners ride. Okay. So, you know, it goes against human emotion to admit you're wrong.
Right.
And
no one wants to do that.
Take your profits. But you know, also with the smaller stocks, and generally all of our stocks, we have sell half and a double. You know, take your investment off the table and let your winnings ride. And you know, then around you know, April, May, we look for our sell signal. Okay. And we don't sell in May and go away. We reposition in May. Not necessarily May, but May through July, when you sort of rotate from the end of the best 6 months to the end of the best 8 months for NASDAQ. July's got some strength as the first month of the third quarter, at least the first half of July. So when we get those MACD sell signals using the 12-26-9, which is the slower, longer indicator versus the 8-17-9, which is what Jerry Appel originally put out in his book. Good friends with Marvin Appel, great guy also. I don't know if you ever talked to him, but
no, I never had a chance to talk to him. But
great with
legend Jerry
Appel.
Appel.
Yeah, he's a good guy. But when we get that sell signal, we're not selling our winners. We'll tighten up stops a bit. Anything that's underperforming, you know, that doesn't look like it's doing well, we'll sell out. And then we'll look for some things that are in the more defensive category and the sectors that do well in the worst months, like utilities. Some years we might even short materials, which is a really strong negative bias in the worst 6 months. We'll stay in staples. Healthcare does well in the worst months. So, you know, it's not a black box system. I mean, best and worst 6 months itself is black box, MACD. We had, I don't know if you know, David Aronson did that book, Evidence-Based Technical Analysis.
I've heard it. Yeah.
He took about 6,200 different black box systems and put them through the scientific method, which I had to learn what that was. It's basically disproving the null hypothesis. So you assume that the results are the result of chance and have no predictive power, and you have to go back and prove that it does. So unlike all the other systems, he proved that the best 6 months, starting from the year after it was published in the Almanac first, which was 87, going forward, that unlike any of the other ones, it did have predictive power, and the results were not the result of chance. So that one's black boxy. But the other stuff, you know, you take that seasonal overlay, looking at fundamentals, what's going on in the world, the technicals, protect yourself with some stops. I mean, we've had stops that were too tight, you know, you get whipsawed out of something sometime. But for the most part, you protect yourself for those, you know, those the negative probabilities that you were talking about earlier, as well as, you know, the unexpected things that could happen in the world.
Yeah, and I think one of the huge keys for the listeners to get out of this is you have your system, you understand the system, and you've really made it your own. And you've done it over the years, and so you can notice the subtleties and things like that. Much like, you know, Justin and I and everyone at IBD, we're starting the CAN-SIM system, and over the years have become experts at that. That's one of those huge keys: is you find that system, make it your own, and adapt it to your own personality.
And be consistent. Apply the rules consistently.
Absolutely.
But we have subscribers that, you know, have been with us a long time that take all the information and have their own system.
Right.
As do we.
Me being one of them.
Exactly. Mr.
So
Pre-Can Slim.
These little old ladies will come up to me when I'm speaking, say at the money show or something, and they'll show me their almanac. And it's writing everywhere. And there's a guy that's an options trader. He goes in and he takes the calendar and he fills in all the trades for the year when he gets the book. And they're just it's meant to be written in.
Right.
And hopefully we got some new paper in there this year. And I think
this is beautiful. Whatever you use for this book, this year is really
it's
well
supposed
done.
to be able to handle writing, pens and pencils, because this is meant to be here next to your computer. I mean, I got notes that I scribble. I got to think of something. I write it down, go back to what I'm doing. But the almanac's here for that too. And even in the back of the book, you got those
all the entries.
Yeah, the entries, but some of the stuff's really important. Like even the last page before the notes, which is new this year, is the Gerald Loeb's investment survival checklist.
Oh, nice.
Wow, that's awesome.
This is a wealth of knowledge.
Yes.
For those that don't know, Gerald Loeb was the author of Battle for Investment Survival, one of Bill O'Neill's favorite books. And
I think I have a copy of it from Yale.
Okay. Yeah.
Yeah.
That's incredible.
Exactly. I mean, Bill and Yale ran in the same thought process over years. And then there's the, if you don't profit from your investment mistakes, somebody else will.
Right.
I have a note in my, it might be the book I have at home. My son came running into me when I was working from home. Oh, Dad, you got to buy AMC. He was looking at something. So I wrote it down, the date, who said it, what the subsequent action. I haven't looked at it in a while, but people should do the same thing with us. And we have some of those forms available online. Just an Excel spreadsheet. And also the indicator thing, the pulse of the market, which goes back to the old days of looking at the down Fridays and down Mondays, the performance for the week, new highs and new lows, advanced and decliners, the put and call ratio, interest rates, just a bunch of general. I mean, this is like that monetary, it's a combination of some of the things in the 5 disciplines where we're looking at not just seasonal patterns, sell May and go away, and not just, PEs, and not just, cups and handles or whatever technically, but also what's going on in the broad market. So it's top to bottom, bottom up. So a couple of stocks.
Well, you know what? I want to ask real quick before we get to the stocks, because you're talking about some of these signals that you get early on and some of the rules that you have in terms of making sure that you don't let losses get too big or, selling half once you double. So how do you adjust like midway in maybe your best 6 months or best 8 months? If you've been selling maybe some things that were doing well, or maybe you had to get rid of some things, are you then taking a look at new fodder to put in your portfolio, or what kind of adjustments are you doing midway through your seasons?
It depends on what happens. For the tactical switching strategy, the best and worst months, the best 6 and worst 6, and the best 8 and worst 4 for NASDAQ, we don't put stops on that. We've gotten burned with that over the years. But with the sectors, which we haven't really talked about too much, and the stocks, we have enough in there that you don't necessarily need to put it right back to work. We'll keep a little cash to the sideline. Then when we get into the next buying opportunity. But like when we hit COVID, when we had that drop, we bought some airlines, had JetBlue for a while. We'll throw in a couple of audibles from time to time. If the opportunity presents itself. We just got stopped out of biotech spider XBI, and we got back into that afterwards. There was that sell-off in November there. And we want to be in that sector. I mean, that's the future. I mean, just look at your boosters, or whatever you're getting.
Right.
I mean, it's something that, that's one of my, you didn't even talk about the super boom forecast. I don't know if you remember that one, Arusha.
It sounds familiar, but did it start in 2010? Was that it, or?
Yeah, Dow 38,820 by the year 2025.
And you're ahead of pace too, right?
And of course, based on Yale's, forecast back in 1976 for Dow 3420. But, part of that super boom equation, other than inflation, which we're getting now, and being in a peacetime, is an enabling technology, what I call a culturally enabling paradigm shifting technology. And biotech's always been one of those. I mean, crypto might be it. I mean, the internet's definitely it. Microprocessor was it back in the old days. Indoor plumbing, the combustion engine. Things like that change the world collectively and individually. That touches everybody personally, as well as change the world. So biotech's part of that. I mean, that's what's enabling people to live longer and take care of themselves. And, it's definitely one of those technologies.
Well, let's definitely get into this a little bit more with the sectors and maybe some of the individual stocks, because I think you've got a lot more to share. So let's do that right after the break here. Stay tuned. We'll be right back. Kicking yourself for that early exit? You can prevent them, and it's easier than you think. Go to freestockcoaching.com to see the tool independent traders are using to perfect their trades: artificial intelligence. AI doesn't involve staring at your screen for hours, and no research is needed. Just pick a stock and press a button. Visit freestockcoaching.com to see a live demo now. You need to be ready for rapid market changes, and AI can help you avoid potential losses. Check out freestockcoaching.com to learn more. Trading involves financial risk and is not suitable for all investors. Past results do not guarantee future performance. Okay, welcome back to Investing with IBD, sponsored by Vantage Point. It's Justin Nielsen here, along with Arusha Peiris and our guest, Jeff Hirsch from the Stock Traders Almanac. And Jeff, before the break, we were talking a little bit about some of these sectors. So before we drill down into stocks, maybe you could talk a little bit more about this whole idea of the sector seasonality.
Well, we've been covering sector seasonalities since the early days of the Almanac, and our latest iteration here has been going on for a bunch of years. It's on page 94 this year. There's also a graphic representation on the next couple of pages. But Risha's got this up from our alert on the website on October 7th. And basically, it lays out the whole calendar year with the sectors. There's some longs and shorts in there. We've got the month that it starts, okay, and the month that it ends. And in the middle is a letter, B, E, or M, which stands for beginning, end, or middle, or beginning, middle, or end. So we break the month down into three parts. So we get an idea of when this seasonality starts, whether it's the beginning part of the month, the middle part of the month, the end of the month. There's a certain way of thinking that we have in all of the stuff that we do, all the seasonals, all the patterns, is beginnings and ends of things are important. Middles of things are important. You see how people behave with their behavioral finance tendencies. Everyone pays their bills the same time every month. Mm-hmm. They tend to, do things at month end. Everyone's looking at, so first and last trading days are important. The seasonal, 1 month pattern is very geared towards the beginning, middle, and end of the month. So here we lay out the sector seasonalities using the thirds of the month divided into three parts. And then you can see the returns. The negatives are obviously the shorts. Some of them, have better longer term. We've got three time frames: 15 years, 10 years, and 5 years. But I want to bring you down to the sort of lower half of this chart, to where we are. You can see computer tech starting up in February, and natural gas and that sort of stuff up at the top, coming around on the calendar. But you see October, it's got all those that really dovetails with the best months. That's sort of where all the sectors come into play. Yeah. And then down at the bottom is the XOI. We use the indices, the old school indices, as much as possible, because the data goes back further and has a longer, it's more consistent. But the biggest let me correlate a proper ETF to it. So the biggest the best correlation to that oil, we see the seasonal bottom usually around, and this is for the oil stocks. Okay. Not the commodity here, which
not the spot price,
which is a whole other seasonal pattern. We did a commodity traders almanac for a while. We still use those commodity seasonalities, but this is the oil stocks, the Exxons, your Conocos, that kind of stuff. And with the pandemic, the way things transpired was that there was a lot of demand that went down, and then production went down. The production didn't come back up, and the demand came back up. So oil prices kind of, boomed a bit. So we got into this a bit early, and, I do own the XLE, full disclosure. I bought some right around our best 6 months buy signal. I got it right on our buy limit, which is what, 57.65. It's been up recently. That's one of my QQQs are down, my IWMs are down, but I think the XLEs were up today. So, those are the three big sectors that I'm in for the season here. And if you don't want to pull up a chart of the XLE, you can.
Yeah, let me pull
this is the big oil stocks, and we think that the seasonality is in play. It had a little bit of a dip here in early December. You can see that, right? Mm-hmm. Yeah. So we think that the upside looks like it's breaking out a little bit more. Was it down a little bit today, or at least
it was down just a little bit. It did reverse, yeah.
And I
it was a penny. It was off a penny today.
That's right, yeah. And I should disclose I do own this one too. So
good.
Whenever Jeff and I are in the same thing, the probabilities drop dramatically.
Nice cup there, right?
Yeah. The nice cup here.
I love the way
flat base.
The rollover works on your charts, by the way.
Yeah, no, it's nice. It's definitely, yeah. And Jeff, you can talk about this. It's like a lot of this is simplifying it, right? And making it easy for the average person to understand. And that's what we did with MarketSmith, and that's what you're doing with the Almanac. I mean, that's what makes it happen.
It's just like the newspaper came
That's
alive.
Right. That's right.
Animated. It's great. I missed the daily paper, the big picture.
We all do.
And it was a great advertising vehicle as well.
Yeah, that's true.
Yeah.
That's
really
true.
was good. But now we're all digital, so that's the way it goes. So the XLE oil, we're in that still. You might get a dip, get into it. I don't know if I chase it right here. What do you think? I'm not running after this.
Yeah, you can wait a little bit. I think it's
you
had
might
such
get another
a good
opportunity.
Run. Yeah,
but that seasonality goes to what, July, right? So you got some time here, and then like we had gold a while back, back in 2019, before the whole pandemic thing. We just got into the seasonal gold trade, which is, if you look on that list, it's what, July. Where's gold in there? The short.
XAU.
July to December.
July, yep.
So we usually get into these things. Now here, part of the how do you do this? So we're not waiting till December to look at XLE. We're not waiting till July to look at gold here. Not that we're in that now, but this is an example from the past. We look about the month ahead of time. We look at the chart. We look what a good buy limit is. We want to be able to get into this sector on weakness or at an attractive buy point. So back in the summer of 19, we picked up gold, and it stayed on our list for quite some time. Let's see. I don't think it's still on there.
Wow.
Picked it up July 11th, 19. It's up 22%. We got a stop loss in at 155, the GLD, of course. So, the point being that just because the seasonality ends doesn't mean we're just selling it. We're going to tighten up our stop like we do with anything else. Be prudent about it. Unless, of course, it's already doubled, then we'll probably sell half of it already. So that's how we look at these stocks, these sectors here. Now, there's a couple of picks I wanted to share with you guys.
Yeah.
And I told you a little bit earlier about our methodology, but what we did this year, we only looked at small and mid caps, because the run from in the big caps was quite substantial. And it was just there wasn't a lot that came through the screen that was really attractive. So you can see on our portfolio page, I don't know, you don't really have access to that at this point. That's for subscribers only. But two of the stocks come out of the mid cap basket. We also break down the stocks into three categories. Large cap for us is above 5 billion. Mid cap is 1 to 5, and small is below 1 billion. I used to dabble in the micro caps, and we don't go there anymore because you're not going to have proper reportable numbers. But and we're looking at stuff that's got growth, acceleration of growth, good valuations, and two of the stocks, A10 is A10 Networks, ATEN. We added that to our newsletter portfolio. I don't own this one. Be nice if I did. At 1330.
Okay.
And that is a cloud services company. Just a great state-of-the-art solutions. They're growing organically, adding clients, adding new business, strong balance sheet, and solid growth potential. And was sort of underfollowed. You got it right there. So we're in at 1330 on October 15th.
Okay, around here.
God, I love these charts. It's a nice buy for us. We got in at that base. You can see maybe
really
sort of reverse engineer how we picked our buy limit, but a lot of it is, gaps and consolidations and, double bottoms and just your basic, whether it's these bar charts or candles. We'll look at moving averages, the 50-day to 200-day.
Yep.
I got pivot points on my charts. You kind of got to go snake eye with the charts and sort of just see where that, buy point or resistance point is. So right in that consolidation.
Yeah, no, it's a perfect place.
Nice tightening up right there at the 50-day.
Yeah.
Now, do you worry at all about events coming up, like earnings reports or anything like that?
I don't play that game. I'm not into. I mean, I know people that do. There's clients I know, subscribers that will trade, sell out of the money, covered calls on ahead of earnings reports or dividend announcements, that kind of stuff. That's not my game. We're looking for, great fundamentals, great valuations, under the radar, nice technical picture, some modest relative strength, not too much, but not weak, and something that a lot of people aren't looking at. Nice. And of course, hat tip to my partner, Christopher Mistel, for really doing a lot of the heavy lifting on some of this stuff.
Yeah, no, you can see this in a nice uptrend. You can see where you bought it here. I just switched over to a weekly chart. And also just to quickly mention, for those of you who are listening, definitely go to investors.com/podcast. You can see the video version where we've gone over a lot of charts from the Stock Traders Almanac, and now we're showing up the Mark Smith charts.
You also had another one, a biotech that you wanted to talk a little bit about.
Yeah, I mean, it's not related to the current biotech craze that's going on with vaccines and stuff, but it's a, pain management company, regenerative health solutions, non-opioid pain stuff, which I guess, is important these days with all the opioid stuff going on out there. So this one picked it up at 52.89 October 18th.
And that's
we're up
Pacira
above
Biosciences. Ticker symbol PCRX.
PCRX, my fault. Pacira, I think it's Pacira.
We'll just say PCRX.
PCRX.
Make it easy
on you.
No one
cares about now.
Right.
So they got a bunch of new treatments out there. They've got a lot of positive things, and clearly, you got a biotech company that's got some. Look at the estimates over there. I mean, yeah.
Yep.
I mean, when do you see biotech companies with earnings?
With earnings, yeah.
Revenue. Where's your price to sales on there?
Price to sale. We don't have we have a PE here, but we don't have necessarily the price to sales on it, on the Mark Smith charts at least.
I mean, a PE of 21,
right?
In a biotech
below the
company?
S&P 500, yeah.
I mean, come on. Anyway, this is a nice pickup, a nice screen that we got here. So those are a couple of the ones. There's a few more. I mean, slim pickings were a little slim, because stuff had moved up a lot. So we're not like stock of the month club. That's not our thing. We use our seasonal, foundation and overlay to get into these things. There's a little trade that we have called free lunch strategy, the only free lunch on Wall Street. Sort of a little tongue in cheek, but you're looking at new 52-week lows in December. There's an old, old pattern where stocks making new 52-week lows on December 15th outperformed the composite index through February 15th. Wow. We found that, we wait to triple witching in that third Friday of December because you get a lot of volume, you get a lot of action. And admittedly, it gives us the weekend to work without the goalposts moving and screen through this. There's a whole bucket of them, several buckets this year. And we'll be updating that list a little bit. We picked 23 or 26 this year. And it's only, first of all, it's only common stocks, no funds, no closed ends, no funky anything.
Okay.
And they have to be trading for at least 52 weeks or else the 52-week low is kind of moves. And, we want to make sure that they are real. Like, so this year there was a lot of SPACs on there.
Oh, okay.
Looked like they were around for 52 weeks, but they really just didn't.
Right.
And we got rid of any fly-by-night Chinese domiciled stuff that's just scary. And I'm just clicking on these, but it's just a real, nimble trader strategy. You want to get in and get out if you make a quick buck on it. And we pick the ones that are down the most. This year our threshold was down 50% or more from the high. Okay. And we also do a tight little trading window. Was it we had 3%? No greater, no less than 3%. So can't go down too much, can't go up too much. Got a trailing stop of 8%. And we'll be running through these stocks over one of the next alerts and just see where we're at.
Well, I think you gave us and our listeners a lot to think about here. Again, the Stock Traders Almanac is full of so much information, but there's also stocktradersalmanac.com, as you mentioned, the Twitter handle @almanactrader. So a lot of places for people to get information, data, a little bit of a history lesson, if you will. So thank you, Jeff, for sharing all your insight with us again. And we'll, I'm sure, have you back on soon.
Looking forward to it. Thanks, guys. Appreciate it.
Okay. And on the show next week, we will have Joe Fahmy returning. And so it's always a lot of fun talking to him. We'll get his take on the market, what January is shaping up for him. So that's it for us on this week. Again, hope you all had a very happy new year, and we'll be seeing you next week. Take care. And for this week's notes and charts, make sure to go to investors.com/podcast, where you'll find details for each episode in the podcast episode section. And make sure to subscribe, rate, and review our podcast if you haven't already. We'd really appreciate it. You can also send us your questions and comments to investingpodcast@investors.com. We would love to hear from you and may use your comments on an upcoming episode.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.